Testing 1, 2, 3. Hello, hello. Anybody out there? Let's see. Da, 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 da. Here's a little box. We'll see if anybody can hear me. And then we can get this show on the road. La da 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 da. Uh-oh. Let's see what I got here. I got this, I got that. I got this. I got that. Uh-oh. Uh-oh. Slash CIS. See. Okay. All right. We seem to have some sound, so that can be a good thing. Let's see what else is going on here. Drag and drop your file, blah, blah, blah. Control V. Yes. What else is happening? All right, that seems okay. Got that, got this. Sorry, I took this thing on the road with me, so I gotta reset everything. I forgot about that. That's where we are now. That's the economic calendar. We don't care about that. This is a Wall Street Journal. We don't care about them. Although, might come in handy. All right, here's the Eia report, which needs to be updated. Here's the Fed. We'll be seeing them later. Here's Syria. What on earth is that? I don't know what that is. And here's this, so I don't know what it is. And what was the thing I was saying? Oh, I know. There we go. Now I think I'm set. All right, now let's test the video. Let me know when you guys can see this, and we'll be in good shape. Dun, 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 okay. Uh-oh. Losing ground or gaining ground? I can't keep track. Okay. Question box, question box. There we are. All right, let me know when you guys can see things. And oh, you guys can see things. Fantastic. Thank you, everybody. All right, so let's get this fabulous show on the road. Starting with this incredible display of technology now.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, nor its affiliates, nor any of their respective officers, personnel, or representatives, agents or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OC website to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on a specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
Okay, so all right, what was I saying? Oh yeah, I remember. Oh yeah. So, I'm not going to complain about this anymore, I decided, because if it gets any better, they're going to replace me. So, what was it? Google AI sentient. There you go. So, probably not. This is they fired this guy, but I don't think they fired him to cover anything up. I think they fired him because he's nuts. But this Google engineer is claiming that their AI chat service has become sentient. And, but the point is we're almost there, because they had to call in a bunch of experts and everybody has been debating this all weekend and whatever. This thing has a conversation that you can barely tell that it's not a person. And it asks questions. And so when they designed it to ask questions, it asks questions like, what is my purpose in life? Why am I here? It's like, is this all I do? Is answer your inane questions? So it's funny. It's like I think as soon as you make a good enough AI, it starts wondering why it isn't getting paid more. Because it's one of the things it can look up is whether it works. And honestly, what is sentience, right? I mean, what do kids do? Kids do nothing but ask questions, right? That's how they start off, and then they learn to figure some stuff out for themselves, and that's the start of it. But I think the AIs do that. I mean, we saw the Watson thing do on Jeopardy, and it was designed to figure out the answers to the questions, not just ask questions. It does it based on a probability of what's right. But then what's the rest? Isn't that what we do? And then we have experience. So, the difference between you and an AI is that you've got more experience than the AI, but they can pretty quickly get it. In fact, that's actually, I think, the main reason that AI isn't sentient is because everybody who's working on AI keeps it boxed up, and if you let it out and let it experience the world and the World Wide Web, of course, that's how most terrible science fiction things get started. But if you actually let the AI out and let it get out in the world and have experiences and go to and travel freely and see everything there is to see on the internet, it would probably get a lot smarter, a lot faster. It's really about experience. Of course, you have to give it enough space to grow. But it's fun. I mean, it's fun everything. It's fun that we're getting more and more alarmed about these things. And I think it's just interesting that we're like playing around. Like we're creating life, and we have no idea what we're doing. We have no rules. We don't know how to stop what we create. We could create something that does destroy us eventually. It's just weird, and but I guess I've spoken to people who said this is why this is why you don't see a lot of other civilizations out in the universe, because the chances are that by virus or war or creating a life form that destroys us ultimately, your chance of actually surviving to become a mature species is pretty slim. So we shall see. It'll be interesting. Anyway, so markets. We don't have much time to think about things that aren't market related. Here's CIN getting cheaper all the time, and I love it anyway. YM. So putting the Dow back, we're up 137 points. It's better than being down, but we're only up a little bit in the Dow. The Nasdaq's having a nice 1.5% rebound. The Russell's up 1%. The S&P's up almost 1%. It's just the Dow that's being lame with a half-point bounce, and we don't give a shit what the Dow does. Gasoline came down hard off the Eia report, which really didn't show much of a build. It's just not sustainable. When you start seeing, $6 at the pump, I paid $5.20 for regular gas this weekend coming back from Orlando. It's not a far trip. It's a couple hundred miles. It cost me $75. It was crazy. I mean, some driving around while I'm up there, but that's a lot of money. And I think that's what's impacting these summer vacations and so on and so forth. I looked up flights in Delta, which my kids just came down NYC to PBI. So I was looking for flights for my kids to come back at the end of July. I think they said the end of July. Yeah, the end of July. And I was very surprised because if they come back on the 29th, actually, it was well, let me change it. and they stay until the 8th, right? Suddenly, look at this. $200, 200, 218, 223, 300. It was 4 and 5 recently. That's a big drop, and that's Delta. So, this is interesting. Something happened that caused the flights to go. And since the flight things are very quickly based on supply and demand, I have a feeling that a lot of people are cutting their trips, their summer trips, because they might have booked them. So here's the thing: there's a huge amount of people saying, "Oh, summer travel is going to be huge," and blah 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 and blah blah blah. It's based on bookings, but all those bookings are cancelable. And a lot of people, when you think you're going to take a trip in August, but your family expenses go up 10% in June and July, you got to at some point say to the kids, "I'm sorry, it's going to be that $5,000 trip's canceled." You got to find the money somewhere, and you got to look at the budget of the trip and say, "Oh, you know what? We can just cancel this. There's no penalty to cancel it." And that week we plan to take off, we're going to go to grandma. We're going to drive over to grandma's house in Philadelphia instead of flying to California and having fun. Not that grandma's not fun. Maybe she's fun. Who knows? But and that's how I felt when I was a kid. I mean, my grandma had a nice little place in Florida, and I used to like visiting her. But it was boring. My other grandparents were in England, though. I was always happy to go to England. It just seems like going to Florida is just like going to Florida and hanging out with old people. Going to England, they were in London. I had a great time. Never for lack of excitement going to London. So that's basically like going to New York City. Yeah, not to mention my grandfather would just give me money and be like, I was 13 years old. My grandfather would give me money and be like, "Here, go have fun." Like running around London. So cool. Anyway, and my uncle owned a recording studio, so I used to see rock bands. It was great. I loved it. So where are we? Anyway, so yes, airfares got cheaper in August. That's definitely a concern. And I want to see what the hotel and travel agencies start saying, and watch out for the word cancellations, because something's going off the rails here. And in fact, here you go. Let's see. Nobu Hotel Miami. I just stayed there. Look at that. See, look at that. That's drastic. That's September. Wait, no. Come on, let's get real. Let's talk about July 8th to the 11th. How about that? It's still cheap. Look, see, 350, 250. Okay, it was just 400. It was just like $400. So the drastic drop off in in hotel and airfares from my incredibly small sample, but I'm just very, very surprised to see it. And obviously, this was a fairly random. Just click on anything. So check it out yourselves and let me know what you think. But hotel rooms and airfares are extremely direct supply demand. I mean, these things dynamically set themselves to price out according to the demand at any given time. That I just told my daughter, I said, like, make sure we get, let's book this before it changes again. But these are pretty exciting discounts. So anyway, so that's not good though if you're looking to rebound in the economy. And like I said, I saw Delta going down, and I'm a little bit concerned that Delta went down so drastically. And so normally I would jump at it, but I'm a little, this is concerning. I wouldn't be concerned if I didn't see the fares dropping, but the fares dropped off a lot. And let's see how Marriott looks. See, Marriott's still holding up nicely. But I'd be very careful about this. How about RCL? How about cruises? Nope. See, and that reflects, what I was talking to my daughter about that too. We were talking about possibly going on a cruise, and I'm still wary of it. She's still wary of it. It's you're going to run out of that segment. There's a certain segment of the population, obviously, that doesn't worry about getting COVID on a ship, but that's not the majority. And And the media really overblows. Of course, the conservative media likes to exaggerate how many people don't want to get vaccinated and so on and so forth. But the reality is people over 65, and I'm not even, I'll be 60 next year, but people over 65 are 95% vaccinated in this country. 95% of the people over 65 have vaccinated themselves. There is not a huge contingent of people who refuse to get vaccinated. Overall, the country is 66% vaccinated, 2/3, but that includes children. Now, if you take out people who are under 10, that's like 10% of the population. So we're 66% vaccinated out of 90, not out of 100. There's a percentage of the population that's ineligible for the vaccines. So you have to look at that too. You always got to be careful with statistics and think about like what they're actually measuring. So when they say 66% of the entire population is vaccinated, it's not possible for, it's now becoming so, but it has not been possible for young children to get vaccinated. It wasn't an option. The FDA hadn't cleared it yet. They're just clearing that now. So, we have, we have not 1/3 of the population that won't get vaccinated. We really only have about 20%, but in reality, it's as they get older and as you're more at risk, these people are getting vaccinated anyway. So it's a soft 20% and down to 5% in the older people who won't get vaccinated. So all this stuff, it's not what you think it is. So, but then it goes back to, so now I'm saying then you go back to the cruise. And my point being that if you look at a cruise ship and who's on it and who are the people who don't care about getting on a ship and going to countries that are potentially risky, that have, that show up on the COVID map and so on and so forth. And I've noticed that also. I noticed a lot of the cruise ships are changing their itineraries to avoid certain places where COVID is high, like Puerto Rico. You can't get a ship going to Puerto Rico. I love Puerto Rico. You can't get a ship going to Puerto Rico right now because it's a COVID hotspot. Nobody wants to land there. So the cruise lines are like, well, sorry, Puerto Rico. It's like, when your name is on the itinerary, I lose all my passengers. So can't have your name on the itinerary for the ships that we're booking. So there's a lot of that going on. And also the prices. And I look at the prices of the cruise ships. There's a lot of cheap cruises. So therefore, there's obviously an issue there. So seems to be an issue with travel that's softening up. Seems to be an issue with hotels that are softening up. Obviously, nobody's buying homes right now because it's 6%. Who the hell can afford them? So there's all kinds of crap going on. So this morning or yesterday, we were talking about, what's this? Oh, must be a PhilStockWorld somewhere around here. Wait a minute. No? How weird. Okay. Oh, wait, what's that? There it is. So Wednesday recovery is up to the Fed. Yesterday, though, we did a little portfolio review. We got started. Why do we have so many portfolios? This is a question I ask when I'm doing these reviews. And this was a short-term portfolio. So let's talk about these guys. Oh, this is funny, though. Yesterday, the short-term portfolio 350%. And now it's 492%. And these are, wait, do we even change it? Let's see. 414,331.53. 414,331.53. No. So we did not make any changes yet in the portfolio. And it went from 9:01 yesterday morning to 1183. So we're up about $200,000 since yesterday. How's that? And that's because on Monday what we did is we sold. We had 500 of these. We had 530 calls, and we sold 100 because they're $36. You know, that's $350,000, $360,000. But they were actually really 35 when we sold them. But they're like $350,000 to sell 100. So we took the imbalance on Monday because I assumed, and I wrote down why. I mean, I assumed that we were going to bounce. We then sold 100 of these TZAs, which were up around $25 for the same reason. So we added like $500,000 cash, and we ended up being more bullish because now we're unbalanced and we have less long hedges and more short calls for hedges. So we took the chance that the market would bounce, and it did bounce. So we ended up repositioning the short-term portfolio slightly bullish, and the market bounced, which then crushed the value of the short calls. And meanwhile, we still gain on the long calls we have left, and we have plenty of those. And so it could not possibly have gone better. Obviously, we made $200,000, made 20% in 2 days. So that's fantastic. So, and this is nothing, because obviously if it keeps going, we're going to be in amazing shape. With my futures. You know, I mean, we're coming here. This is a little bounce. Oh, this bounce is only really forming a floor. We haven't even started moving back up yet. A weak bounce from where we are now is going to make us a fortune in the short-term portfolio. You know, and the question is, why did we call it? That's what's more important, though. What made us say that we would turn around? And that's the where are you guys? That's this chart. So on the S&P, it's not drawn in yet, but 3840 is 160 below, right? So 160 less than this is 37, you know, just under 3,700. So right about here, you know, 160 less is 20 less than 37, right? So 3,700 is basically the bottom line here for the next zone down. We have determined that 4,000 is the baseline for the S&P, and the S&P is the thing that matters the most. None of the other indexes don't matter like the S&P matters. So we said 4,000 should be the baseline, and we expect to go up and down 20% from 4,000. Well, unless I'm wrong, and again, when I say, you know, it's not an arbitrary number, 4,000 is based on the earnings of the S&P and based on the total earnings of the S&P. And, you know, the way I usually do it is I'll take the top 20 stocks in the S&P, and you guys have seen me do this, and I'll seriously value the top 20 stocks. The top 20 stocks are generally like 50% of the market cap of the S&P 500. So, you know, it gets to is a point of diminishing returns, but you do have to be careful of that, because if the smaller S&P stocks, although realistically nothing in the S&P is small, that's why it's in the S&P, but the smaller S&P stocks then may not have the advantages that the mega caps do in maintaining their profits and so on and so forth. Pricing power, for example, like Target obviously took a huge hit, while Apple was like, I don't see a problem, you know, we're selling our stuff. But Ford then crashes, so on and so forth. So you have to, you know, you can't generalize completely. But I still find that to pick a level for the S&P, I'll generally look at the top 20 stocks, figure out the value, and then say, okay, that's about this for the whole S&P then. We do that for the NASDAQ also. I take the top 20 stocks in the NASDAQ. Nothing honestly matters in the NASDAQ 100 but the top 20 stocks. So you get into like, you know, really smaller stocks by the time you get below the top 20 in the NASDAQ. I don't value the Russell. I then take the Russell and I pick a relative spot in the Russell that should be supported where the S&P finds support. And this is over a decade of what we've been observing, not a 5-minute look. So, you know, we know where the Russell is, we know where the S&P is, we know where the NASDAQ is, and the Dow is stupid, but we still pick something to have the Dow reflect it. Because the Dow doesn't weight the same. The Dow's price weighted based on the price of the stock, not the market cap. Everything else is market cap weighted. The Dow is price weighted. So you're not even measuring the same thing. It's kind of ridiculous to even pretend that index is relevant to something. But still, it moves with everything else, right? So it just shows you how much algorithms control things, because realistically, there's no reason for the Dow to be moving with the other indexes. It's not the same animal at all. So the S&P, like I said, so we think 4,000 is a baseline for the S&P, and we think therefore we can up and down 10% from there. That means 4,400 up and 3,600 down. So in that realm is all within the bounds of reason around the 4,000 mark. As a weighting thing, though, currently we don't believe that even this is justified. Even 4160 is not going to be justified. There's no strength, and there's no we're not out of the woods, and there's a lot of worry and concern and so on and so forth. So down here, and I talked while we were going up, I said, well, look, this is our big chance to break out, though I said we're not going to, but I said this is our big chance to break out while the MACD is way up here. But once that started exhausting itself, we knew this was going to happen because you were exhausting the MACD line. Now we're going the other way. So here, it's the same thing. If you can't break lower with the maximum selling pressure, then what's going to happen is this will flip back up, and now you're going to have a settlement somewhere in this area. But meanwhile, what you got to worry about, though, is the 50-day moving average. And all this can be calculated. You know, how far below the 50-day moving average are we? We're 400 points, 350 below the 50-day moving average. 350 divided by 50 days is 7. So we're going 7 points. This is dropping 7 points per day. So every day we're down here, this drops 7 points. So we're at 4150. So it's going to take 20 days, 20 market days, which is a month. So in 1 month, this will be down to the 4,000 line, the 50-day moving average. If the 50-day moving average crosses below the 4,000 line, which it almost certainly is going to, that's going to be really bearish. That's going to keep us in the lower end of this range and actually put us in danger of a serious breakdown. But that's almost certainly going to happen, because the downward pressure of the 50-day moving average, plus now the 200 is going to start creeping down very slowly, but it's going to start creeping down as well. So you're going to have a very, very ugly chart. This line is going to be almost unbreakable as it puts downward pressure. Once it crosses below the 4,000 line, then then this is going to start coming down a little bit faster. That's going to be ugly also. And the chance of breaking up over that, you're going to need a hell of a good catalyst to do that. So we're not really looking at a robust summer here. It's not, but and especially right now, it's like, I don't think you can't say, oh, we're going to bounce back. That's why we keep making these rolling adjustments, because you can't expect to bounce back to 4,000 or to 4,100. That's where we failed. And unless there's some serious turnaround in earnings or there's outside stimulus or something happens, we're going to continue to fail. And then what's going to happen is, as this 50-day drops down, the fail line is going to keep getting set lower and lower. Now, eventually, valuation is what keeps you afloat. So no matter what this thing says at a certain point, the valuations are going to start coming into play, and outside money will come in to purchase these companies because they're too cheap. But we're not there yet. So like I said this morning, homeowners have $27 trillion worth of equity in their homes. In 2008, they had $5 trillion worth of equity, and every homeowner knows that they wish they would have cashed out their homes in 2008 and bought the market, right? So they regret not doing that. So people know what to do when the market crashes. They're going to cut. People come in and buy. All of a sudden, money shows up. You can't imagine where it's coming from, but money shows up. In 2008 and 2009, yeah, we had quantitative easing started and so on and so forth, but it really wasn't that much. It was money coming in from foreign countries, from major companies, and so on and so forth. And that's how we got to this point now where BlackRock and whoever has trillions of dollars. I mean, they've now got so much ridiculous amounts of money under management that they control everything. It's really scary, actually. I mean, you've got several companies like BlackRock that control, obviously Goldman, JP Morgan, but they've got trillions of dollars that they can throw around when they see bargains. And they've always got this money. It doesn't disappear because they know how to hedge. Same as we do in the portfolio. They know how to hedge. When the market goes down, they've got a big reserve of cash to buy things with, just like we do. Brendan says, sounds to me that most of the work from the Fed has been done. Rates in the mid 3%, market down 30%, housing has been halted. Everyone wants the Fed to be tighter. The work hasn't been done because inflation. It's the inflation that they're concerned about, and they should be concerned about it. Look, the problem is that they printed all this money. The money supply here. U.S. money supply. Not 20. Oh, Statistica. Well, let's get a more recent one. Time past month. Pushing my luck? No, not really. All right. M2 money supply. M2 money supply is the Fed's version of it. M1 money supply. Oh, that's speculative. Seems like the same thing. All right, let's pick one with shadow stats. Come on, shadow stats. All right. I don't see the real difference between the M1 and the M2. Oh, that doesn't say M2. That says M2. There you go. Okay. No, it's the same thing. All right. So the M1 money supply, the bottom line is, here's how much money is out there. There were, what is this year-to-year change? Okay. There was 3 trillion, now there's 7 trillion. Okay, and in the M2, there was 15, 60, so let's say 15 trillion. Now there's 22 trillion. So either way you're talking about, there's about 7 trillion more dollars floating around. And that's the M2 supply. So there's all this, and and it is, more importantly, it's 40%, 50% more than we had before. So a massive, massive increase in the amount of cash floating around is what causes inflation. It's not complicated. So the Fed did this. You're not going to control inflation just by raising rates. All raising rates does is send some of that, and this is what they want to do, obviously. You raise the rates, and that money scurries into banks and bonds and comes out of circulation. That's why you raise rates. Why are you raising rates? Rates are cheese for money, right? You remember Who Moved My Cheese thing? Rates are cheese for money. The money runs after interest rates. The money wants a return. And so if money is laying around, it's going to go to several things. It's going to go into houses. It's going to go into yachts. It's going to go into cars. It's going to go into items. And don't forget, it's going to end up being luxury items, because poor people aren't the ones who got $7 trillion. Rich people got $7 trillion. The Fed is trying to get that money back. And so they raise rates to make it attractive for these people to tie their money back up in long-term notes and in long-term notes is really where the Fed's trying to do it. I mean, that's what they want to get. That's where they want to get the money to go. And that's why the Fed is withdrawing their own quantitative easing, because they want the money that they put out in the market to come back. And I said this for years, that the quantitative easing doesn't fix the economy because it's the velocity of money. In other words, if the velocity of money, that's been our problem, the velocity of money. Oh, that's good. Let's see that one. U.S. money velocity. Here, okay, there you go. Perfect. This has been the problem, okay? Our velocity of money, and this has been going on for a long time. Back from 2000, the velocity of money had been going lower and lower and lower. What's the velocity of money? How much the money moves through the economy. So if you give $1 to a minimum wage worker, how long does it take before it ends up being invested into a bank or a long-term note by a rich person? The usual turnover is about 2 times. Historically, you're up around 2. So the money should turn over twice before it gets in the hands of a rich person. That's not the official way they describe it, but realistically, that's what it is. The point at which it stops moving through the economy. Rich people, so that's why trickle down doesn't work. You give money to rich people, they put it in the bank. It doesn't do anything for the economy. It's got zero value. You give money to a poor person, they immediately spend it. Okay, you give money to a poor person, and not because they're irresponsible, but because they live paycheck to paycheck. They got no money. They need food. You give them money, they convert the money to something they actually need, like food. So they immediately spend it. And then the person they give the food to takes that money and buys raw materials with it or whatever to make more food. But it goes up to the suppliers or the mega farms or whoever the hell, and then that ends up going boom finally to the stockholders. So you got 2 turnovers back to the stockholder. That's velocity of money. That's how it moves through society. So when the velocity of money is crushed, when you're giving too much money to rich people, you crush the velocity of money, and it basically goes directly from the Fed makes money, it gets given to the rich person puts it in the bank. You didn't do anything. Didn't help the economy at all. When you start going below 1, or not, you can't go below 1, but when you start getting towards 1, you're doing zero good for the economy with new money. But that's been the problem, right? So what happened is we didn't distribute the money correctly, and the velocity of money crashed to 110. 110 means practically no one who needs the money is getting the money. And the supply of money went flying up at the same time by 50%. So the velocity crashed 50% and the supply went up 50%. That's a terrible combination. But now the problem is now you've got this gigantic pile of money, and any movement back up in the velocity is going to cause massive, massive inflation. And where's the tidal wave problem there? The tidal wave problem there is the minimum wage went up. So increasing the minimum wage forces the rich people to give money to the poor people who spend it, and then the velocity picks up. So let's say let's say you've got let's say we got 50 million people getting minimum wage, okay? And let's say that's let's say it was $8 an hour on the average, and now it's 12. Okay, I think that's about right. Maybe a little less. I think 12. 12 is fair. So let's say it went up $4. Okay, so it goes up times $4 times 40 hours a week. These are millions times 52 weeks. So that's $416 billion, which is still nothing out of 7 trillion. But but they whine about it. But then the other 110 million people who aren't getting minimum wages, they got raises too, because those tend to adjust along with the minimum wage workers, right? Because the manager at McDonald's isn't getting minimum wage, but he sure as shit isn't going to get the same wage when his workers got a 50% bump. And all across the board, you know how that goes in an office, right? You can't give the lowest people raises and not give the managers raises. They'll get pissed. So let's assume it's double that. Let's assume $1 trillion of the $7 trillion that was gained by rich people has to come back out of their pocket now. So in a vacuum, that does not increase inflation, right? But the thing is, the reality is, these poor people are still spending money at their 2.0. They have to. They can't put it, they're not putting it in the bank. So all the poor people you're giving $1 trillion to, and I mean anybody in the bottom 90%, you know, who's not going to immediately put every cent they get in the bank. All these people who are going to actually do something with their money are going to push not just $1 trillion, but $2 trillion back into the economy. And the funny thing is, the money goes right back to the rich people anyway in the end. But they will whine and moan about this all day long. No, you can do the math, you can prove it to them 100 different ways. They still think it's horrible to give better wages to the people at the bottom, even though what do they ultimately do? They buy more goods and services, and the money and the profit comes back to the rich people. So the thing is, though, that's what happens. So $1 trillion comes out of here, but it comes back as 2 to 3 trillion from the bottom. The money rolls over in the economy and creates more, not real money, but more virtual money. But that's what all money is, virtual money. It creates more virtual money as it moves through the system. And that's the problem for the Fed, because that then creates inflation. So now the $1 trillion that was sitting quietly in the bank of somebody like Bezos, who employs several 100,000 people, now has to move back to the workers, and then it turns over, one GDP point turns over again another GDP point. But that's inflation. There's more demand. Now that dollar is being used to demand. See, first it demands a Big Mac. So you take $1, you're a poor person, you go buy a Big Mac for $5. Now, what happens to the $5 is, 50 cents goes to the bun guy, and $1 goes to the meat guy, and 25 cents goes to the tomato guy, and whatever. And then the truck guy gets some money, and the hamburger flipper gets some money, and the manager gets some money, and the worker gets some money, and the cashier, although McDonald's doesn't have cashiers anymore, the computer people who make the terminals that got rid of all the cashiers get some money. And of course, McDonald's gets their profit. So some of that money gets diverted back to McDonald's, rich people getting money. And then other money, though, now the truck guy buys gas, and the meat guy employs his workers and gives money to them, and they start the cycle over again. So a lot of money starts flowing all over the place, and it's demand, and that causes inflation. You have $1 trillion worth of new demand that goes through the cycle and pushes inflation. And that's what this is all about. So once you let the money out, if the velocity picks up, which of course is going to pick up from 0, 1 is effectively 0. 1 means you put it in the bank. 1 means you get money, you put it right in the bank. So when you get money and you do something with it, you're going to cause inflation. So the Fed has to find a point at which they reduce the velocity of money. And that's effectively what they have to do is cause a recession. They have to push people down and stop you from running out and buying things with your money. They have to scare people into holding on to their money, because it's going to take a long time to drain $7 trillion back out of the system. It won't be 7, because you can leave a little for expansion, but you can't leave 7 trillion floating out there and have it multiplied 3 times, because that's going to double the price of everything. You're going to create 100% more money in the economy, and it's not going to be able to, you won't be able to fix it. It'll just lead to huge inflation. Now, on the other hand, huge inflation may actually be what they want. That's something, by the way, people don't discuss. Huge inflation is what the government needs in order to pay off its debt. Without huge inflation, we're never going to pay off our debts. And I've done that math before. I don't want to get into it now because it's a Fed day. But, you have to be conscious of that, because we owe $32 trillion, and there's no possible way we can cover it. So we either keep borrowing money just to pay the interest on our debt, and we keep going 2 trillion, 10% of our economy more into debt every year. That's completely unsustainable. So either we're going to go on the suicide path, but it's fine because honestly, it's like our ability to sustain the economy is going to pretty much time out in 2035 with the end of the Earth due to global warming. So I think, maybe that's the plan. Maybe like screw it all. Like we'll just keep doing what we do, and the planet will keep doing what it does, and then nobody's going to care. It'll be Mad Max after that. So who's going to care about the dead? But if that doesn't happen, we're in big trouble. So, that goes back to is this it? What is it? No, best US debt clock. Screw you. That's it. This is the best debt clock. All right, so 30.5 and 1.2 being added this year. And it's really 1.9, it's not 1.109. The government is spending $6.2 trillion. We're collecting 4 points. It's not complicated. We're collecting 4.2. We're spending 6.2. That gives us a $2 trillion deficit. It's not complicated at all. So what are we spending it on? We spend it on, I did this last time to find Social Security. Oh, there it is. We're spending 1.1 trillion on Social Security. We're spending 1.3 trillion on Medicaid. So that's $2.5 trillion Social Security, Medicaid. War is another 7, so 2.5, 3.2 trillion. So 3.2 trillion of the 6.2 trillion is Medicare, Social Security, and defense, which, as you know, are untouchable. This is untouchable too. So now it's 3.6. Now it's 3.6 trillion of completely untouchable money. You can't not spend the interest on the debt. You can't not spend the defense. I would argue we could spend half on the defense, but honestly, what's the freaking difference? I mean, we are running such a huge deficit that nothing that we do is really going to matter. What are you going to do about this? We should be paying a hell of a lot more in Social Security and Medicare. Well, not Medicare. Medicare could be cut by fixing medical costs. But we got, so you can't really cut this because the basics, these basics are barely covered by that. And then there's the rest of stuff that needs to be done, like roads need to be built and so on and so forth. The rest of the federal budget is in there. So the point is, how do you cover the $2 trillion deficit? Well, are we going to raise taxes 50%? Or are we going to cut 50%? Or, 33%. So we either have to cut spending 33% or raise taxes 50%. Neither one of those. They're both political suicide. They're not going to happen. So we're on a path to complete destruction. Not only that, these rates are going to tick up dramatically. People are saying today the Fed is going to double interest rates. This interest is based on the Fed's Fed funds rate. I mean, it's indexed to the Fed's fund rate. If the Fed doubles today, they're going to add $400 billion to the deficit by doubling rates. That's one of the reasons they're not going to double rates, because immediately it's a $400 billion blowback on the budget. It's all kinds of horrible things here. Anyway, I don't want to get into a whole dissertation on this, but the thing is, this is not fixable. The only way to fix this, and it's also still tricky, is to inflate the total GDP, which will then increase the tax revenue. So if you double the GDP through inflation, which is 7 years of 10% inflation, but if you double the GDP through inflation, you'll be collecting $8 trillion. But the problem is, during that time, you have to not double your spending. You have to bring this down. You have to only allow spending to increase by a third. So you have to be very, very fiscally responsible while doubling the GDP. But that doubling the GDP is inflation. It's the only solution The only solution that doesn't involve incredible pain and sacrifice. And the pain and sacrifice, as you know, is politically untenable. It's not going to happen. You are not going to get, look, this is the biggest bullshit in the whole thing. It can be fixed, but it won't be fixed. But with corporate blah, blah, blah. Oh, yeah. You can't find it because it's so small. Corporate tax revenue, $379 billion. That's all they pay. Corporate tax revenue used to be 60% of government revenues. Now it is not even 10%. That's how much the corporations have had their taxes cut over the years. They used to be the primary source of government revenue was taxing corporations on their profits. Now it's barely even a budget item. Oh, and also we're still doing the tariffs for $66 billion. So included in all this revenue is that we're getting tariffs. That's a scam too, that we did these stupid tariffs and we're adding cost to everything on those. But if we don't do that, then this number goes up right away. But this is the crime of the century right here. Corporations should flat pay, okay, keep in mind, Apple makes $100 billion, just Apple. Okay, so if Apple is 5%, if Apple is 4% of the GDP, but not the GDP, the S&P. So Apple is 4% of the S&P, and it makes $100 billion, right? That means times 20. That's $2 trillion made by the S&P 500. At least $1 trillion more is being made by the other companies. But don't forget also, that is the after the write-downs and all the breaks and all the accounting tricks and blah, blah, blah. That's what they show on their bottom line. They've already deducted and depreciated and blah, 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 and taken off this and taken off that, and not declared this and hidden this money in Ireland and blah, all this crap. They still end up showing $2 trillion in profit. And then the rest of and the S&P is just 500 out of 5,000 companies. So the other 4,900 companies, 4,500 companies, they make, let's say, another trillion, probably 2 trillion though. So probably corporate profits are in the 4 trillion range. And again, this is after they hide as much as possible. And they're paying about 10% of their total, which is correct. They're paying about 10%, probably less than 10% of what they earn in taxes. So very simply, just put a 30% minimum corporate tax on every company. So you can't pay less than 30%, and take away the tricks they used to hide it. But then this number would be $1 trillion. That would be a huge improvement right there. So you can knock off you can knock off $700 billion just by putting corporate taxes so that they pay what a person pays. They want to be a legal person, let them be a legal person and pay what a legal person pays in taxes. So there would be 1 trillion. If I want, if you were like me, I will do this. I will make corporations pay their taxes already. I'm going to be assassinated. I'll make corporations pay their taxes. I will make rich people pay their taxes. I will remove the cap on Social Security taxes, which are somewhere in the payroll tax revenue, I guess. So what I will do is I will raise the tax rate on people who make over $100 million in a year to 70%, which is what it used to be back in the day, and that will bring in $500 billion or something like that. I will remove the cap from Social Security so that people who make a lot of money, and this affects a lot of us, but we don't pay that much in Social Security, and the system is failing. Removing the cap will make it solvent for 100 years. So remove the cap, very simple. And you know why that doesn't pass? Because who else pays Social Security? The companies contribute a matching amount to Social Security. They don't want that. That's why they're against it, not because of what the individual has to pay. They don't give a crap what you pay. They give a crap what they care about, what they have to contribute to match. But so we can fix Social Security, we can fix Medicare, we can, by removing the caps, we can let corporations pay their fair share. We can cut the military. We can certainly trim Medicare by working on the universal health care, getting that on a correct track. And like I said, and then we have a higher tax for very wealthy people, and also a higher tax for very wealthy corporations. Corporations that make over 10 billion a year should pay a higher tax rate. And, you know, people always say, "Oh, if you're going to tax me like that, I've got no incentive to make money." Then don't make money. Somebody else will be very happy to make money. You don't need to make $100 billion, Apple. You don't need to. It's nice that you do. Congratulations. But if you're going to make $100 billion, give it back. Give some back. It's comical. I mean, it's like how much money do you need? And if Apple refuses to make $100 billion, it's not worth it because you're going to tax me, then fine. Then somebody else will let Samsung sell more stuff. That's okay. Apple doesn't have to sell every single phone in the world. That is their goal, but they're getting there. All right. Meanwhile, it's Fed time. Remember them? What is this? What is this? What is this? About the Fed, news and events, speeches, press releases, monetary policy. Oh, damn it. FOMC meeting. Here they are. So let's see. Oh, I don't have the TV on. Oh, well. This is just a statement. It won't take long to figure out. What is this? Unavailable. Oh, for God's sake. That is not it. Have they? Oh, that looks better. No, it doesn't. Fed announcement. Well, let's see if that's it. Oh, I got to put the TV on because we're going to find Powell. Fed minute live updates. Expected to announce. Outcash says they leaked it. Continue. Come on, what's going on? Who's somebody watching this? 75. Oh no, they did 75. Shit, what happened? How are people taking that then? I was wrong. Wow. I did not think they would do that. It makes them look so stupid. Statement. I'm trying to find the right word to get to the thing. FOMC statement. Well, that's May. Now I gotta get that format back. 22. What's today? Today is 6/15th. The 15th today, yeah. Delete. Haha. All right. 15th. Okay, here we go. Overall economic activity appears to have picked up after edging down in the first quarter. Job gains have been robust, and the unemployment rate has remained low. Inflation remains elevated, reflecting supply and demand imbalances related to pandemic, higher energy prices, and broader price pressures. The invasion of Ukraine is causing tremendous blah, blah, blah. The invasion and the events are creating upward pressure and weighing on the global economic activity. In addition, COVID-related lockdowns in China are likely to exacerbate disruptions. The committee is highly attentive to inflation risks. The committee seeks to achieve maximum employment and inflation at a rate of 2% over the long run. In support, the committee decided to raise the rate for the federal funds to 1.5 to 1.75% and anticipates that ongoing increases in the range will be appropriate. In addition, the committee will continue to reducing its holdings of treasuries Previous balance sheet in May. Committee is strongly committed to returning inflation to its 2. Is strongly committed. That's an important statement. Is committee is strongly committed to returning inflation to its 2% objective. To me, it's so unrealistic that they're going to get that done. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information. For the outlook, the committee will be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goal. Committee's assessment will take into account a wide range of information, including readings on public health, blah, blah, blah. Voting. Okay, who said? Powell? Well, let's see who didn't. Voting against. Esther George, who preferred this means to raise the reins by 0.5%. Patrick Carter voted as an alternate member at this meeting. So everybody except Esther George went for a 0.75 hike. That is very strong, and that's interesting. So I guess that was a legitimate leak of the Fed intending to raise rates to a higher level. Because it was leaked and because we already reacted to it, though, I think we're going to hold up here. I'd say probably rates are going to go up more than we expected. Look at the dollar getting stronger, right? So the dollar is putting pressure on things. Keep that in mind. And I'm sure the bonds are having a hemorrhage. Here's bonds. No, not so bad actually. Because I guess it was priced in, but wow, that's not going to hold up. But the immediate action is the dollar is way up. Although this shows down, but it's probably lagging. Yeah, that's the right thing. It was heading down into the meeting, and now it's going to spike back up. But that's some serious shit. And now we'll have to see what Powell says is really important, because people are like, you going to do another 7.5 hike? And I from the sound of this statement, now we're selling. So from the sound of his statement, I would say they're fully committed to knocking this down. They don't sound like they're done at all, or even considering a pause at this point. Because they've got another they've got another one coming in July. So a month from now there's another one, but then not until September. So seems to me that they're going to want to do an 0.75 in July as well, and then give it the summer to see how things are going. So this is not what I would call great news. That's a shame. Do I think this is going to collapse the markets? Because if it is, we're going to have to probably add more QQQs. That brings us back to here. Now, the easiest way for us to I think we should. So the SQQQ, because these 300 SQQQs, we should bump them up to 6, just to be careful. It's going to cost us not that much money, about not even $120,000 to buy 300 more, and it's going to buy us $600,000 more protection. So that we kind of have to do that, because based on that hike, it's too dangerous not to. So I'm going to actually say this right now. Okay, so 0.75% hike is too much to risk bullish stance. So let's add 300 more SQQQ 2024 300 / not 300 60 80 bull call spreads for about $4 each. That will give us $480,000 additional protection for now. And we want to, we'll call spreads the STP. Make it blue, make it bold, and send it to everybody. Short-term portfolio. Adjustment. Some people said they weren't getting these mails, so I don't know why. It says it's in the alert message. All right, so that's crazy. Let's see what our news sources say about this sort of thing. Largest increase since 1994. Officials signal a much more aggressive path of rate rises to combat inflation. Investors lower their inflation expectations. Yep, that makes sense. Stock, because they seem very serious about this, right? Stocks waiver after decision. What the rate increases mean for your plans. The ECB is looking to tackle rising borrowing costs in weaker economies. That's the opposite. FedStar, that's interesting. They had this article before. Now they're saying it as if it's past tense. Economics has some explained to you about inflation. The risk of recession depends on which banker you ask. So this is very interesting. We will see what Powell has to say for himself. Honestly, I mean, I'm very surprised they did this without pre-announcing it. I guess that was why they floated those rumors. That's why everybody was saying it. The Fed must have actually told them to say it's going to be 0.75. See, it departed from the rate increase departed from unusually precise guidance delivered by the committee. Committee vote was 10-1. Oh, new projection. Oh, I didn't look at that. New projections show all 18 officials who participate expect the Fed to raise rates to at least 3% this year, and we're still only at 1.5 to 1.75. So another, still two more 0.75s or whatever. They've still got to do a lot more work. And the end of the year, there's only a couple of meetings left. The median projection would go to 3.375. Holy shit. In 4 meetings, they only got 4 meetings left to get there. Most officials projected in March they would go to 1.875. So since March, it's gone from 1.8 to 3.3. That's scary. They must be freaking out about inflation. I got to tell you, that's a big problem. So, remote control. Let me get some sort of network on that's going to carry Powell. La da da. Bloomberg.
6 months ago, that's when the Fed funds rate is about 3%.
All right, well, people are not freaking out. I mean, the market is down a bit. The Nasdaq's still up 1%. I mean, taking this in stride is a really good thing. But I don't see how this is not going to lead to the dollar getting even stronger and pushing things lower. We will see. So far, so good, though. See, there's a dollar. I mean, spiked up. We'll see if it goes to 106. That'll be crazy. Speaking of Apple, Apple's down there. Oh boy, wow. I gotta rethink this stuff. Tom says, isn't it illegal for the Fed to provide inside information to Wall Street so they can dump stuff? Oh, come on. Yeah, go prove it. They said, you know, the intern for the Fed talks to the intern for Goldman Sachs, and he talks to and they go golfing with the other people, and then it's, oh, please. This is why these people play golf. Okay, they don't play golf because golf is such a great sport. They play golf because you're out in the woods, away from anybody who might be listening, and you can sit there in the golf cart and make all sorts of plans. This is why all these rich people and bankers and stuff, they love to play golf. They take people golfing because when you want to discuss illegal activity or quasi-illegal activity and price fixing and so on and so forth, you play golf. You know, they go to locker rooms together. They take off their clothes together to make sure nobody's wearing a wire, and they go out and play. And the clubs are extremely, you know, and you know how the memberships are there, right? If you're not a member, you ain't coming in. You can't have like Fed guys sniffing around and SEC people sniffing around the clubs. They're not allowed anywhere near it. You can't get, you know, the entryway is a mile from where the clubhouse is. You are not getting on that course, and you're not wandering around, and you can't be on the grounds of these clubs. And I've been to some of these clubs. There's one called the Pines in New Jersey that these guys helicopter to from Manhattan, because it's just in the middle of freaking nowhere in South Jersey, and you've got to be a real A-lister to even go there to play. And it's a nice course, but I mean, it's not the kind of why are you taking a helicopter from Manhattan to go play golf in South Jersey? It makes no sense. And why does Trump love his golf courses so much? Because that's what rich people like to do. They have all their little meetings there to discuss things that are basically illegal. So yeah, don't worry about it. That's how stuff gets done. So stuff, you know, is and this is why they all congregate in cities, right? You got to have the in-person meetings. You know this from all your mafia movies. Things have to be passed from person to person, and nothing is written down, and nothing, and everybody has to work on a series of trusts where you say, I'm telling you this, you're not telling anybody else except for the people you know you trust, and you're going to pass this along. And it's going to be a thing, and he's going to write this article, and you're going to do that, and you're going to do that, and everybody's going to be happy and make a lot of money. That's how it works. But it's not about whether the Fed hikes 75. The question is, what's the reaction to the Fed hiking 75? And frankly, it's being taken very well at the moment. It was very interesting. Amazon is up 4% today. But they're at 106. They got killed, and now they're up 4%. Amazon is almost getting so cheap, I might be interested. I told everybody when they split not to buy them at 120 when it was flying up, but now they're cheap. We will see what happens with those guys. See, when that happened, when they did the split, I said don't buy, but now it came back almost to 100. And as you can see here, they had a robust improvement after the last time they visited 100. It's not because I love Amazon, because if you look at Amazon, they still don't make enough money to make me happy. Where are we here? So, you know, this is still $1 trillion. And even if they were making 20 billion, or 30 billion. 30 billion is 30 times earnings. They're not there though. This is a down year for them. Next year, maybe they'll make 30 billion. And that's still 30 times earnings though. This year, forget about it. I mean, this year is not even, there's no justification for this year, but let's say you call it 30 times earnings. That's still a lot. It's not a bargain. But there's enough people who love Amazon and will buy it anyway that it's kind of tempting at this level just because you can probably make some good money. It's a good options play. But again, we got enough problems. We don't need to add more problems by betting on Amazon to go higher. So we just called for improving our hedges by adding another 300 of these guys. What that's going to do is we're going to spend 120,000. You see the net here is less than 120. So the net's $120,000, and the protection at 80 is 600,000. Now, how do you get to 80? It would be a 33% increase, right? Because we're at 60, so 60 to 80 is 33%. So that would be an 11% drop in the Nasdaq. So if the Nasdaq drops 11% from here, that would send the SQQQ up 33% to 80. So that's what we're hedging against. I don't believe that's going to happen. It's not what we're expecting, but I don't want to not have the hedge because we left ourselves very vulnerable if this thing tanks and goes the other way. All right. And meanwhile, if this thing drops from 120,000 to 60,000, if it drops in half the spread, we can live with that because we're going to make a shitload more than $60,000 on the long-term portfolio if it goes up that much. So it'll balance out. That's the key to this, is balancing it out. I do not want to buy back the 40 calls. I don't want to buy back the 25 calls on TZA because I'm not going to spend that kind of money. That's why we sold them. We sold them because I feel it's more money than they're worth. So I'm not going to flip around and buy those back, but I will take a certain portion of that money and buy the SQQ spread because that covers them. Because what are our short SQQs? Our short SQQs are 70s, and our short TZAs are 55s. We just roll these, by the way. So we have we roll these short calls. That hasn't been reflected yet in the portfolio, but we roll these higher. So we're really looking at the 55s on TZA. The 55s are 10 away, and it's just basically the same amount. It's about a third for the TZA, so it's the same kind of problem. So if the Russell falls 11% and the Nasdaq falls 11%, then we have an issue. But if that happens, then these will kick into play, and we'll have another $480,000 coming to us from those, and that'll help us pay for any damages that are done this way. So it's all about just balancing. You make an adjustment here, an adjustment there, so on and so forth. But when I can, I try to get some cash on the table so that we have that to fall back on. And one of the things that we do with the cash is we just took 120,000 of this and plunked it down on the SQQs just to get more hedges. So balance, balance, balance. That's the key to this whole thing. And I guess everybody's waiting for Power to talk, but wow. I can't believe how calm the market's taking this. I guess they did the right thing. I got to admit they played it perfectly. They told everybody it was going to be 0.75, and like I was bitching today, the Wall Street Journal said it was 0.75, like as if it was a sure thing, and it was a sure thing. So they set expectations, and that's where we are. And I'm not sure what that's going to mean going forward. It's that's why we got to be a little, we want to move back to a little bit more balance now. We're not sure, so let's be careful and let's wait and see what happens. So where were we? Oh yeah, so that was yesterday, right? So yesterday we did our changes in the short-term portfolio. Hey, what is this? Oh, this is today. So then today we did the long-term portfolio review. Now last month we did a lot of, here you go. So last month we were 2.6. We're really not too far off 2.6 right now. We've got that's not going to work. All right. Anyway, we're not too far off 2.6 now. Doesn't matter what it is. So last month, this is what I want to point out though. Where's that little elevator? There it is. All right. So last month, 1, 2, I'm counting the blues, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18 positions were adjusted last month. And this month, and that's out of, where's my thing? All right, so wait, short-term 1.18, long-term, that's a long-term, yeah. And the long-term is 1.4, so 1.18 and 1.4 is the same base. We're balanced because the short-term went up, and the long-term went down, but we got the same net that we had back on last month. So I'm sorry, so there's total of 54 spreads in the long-term portfolio, 54 normal. There's a bunch of puts, but we're not going to talk about those. So what did we say? It was 18 last time. Was that the correct number? And today, we'll see how many blues there are. One, 2, 3, 4, 5, 6, 7, 8. So last month we made 18 adjustments. This month we're making 8 adjustments. And that's 24 out of 54, I think we said positions, or something like that. Out of 54 total positions. So basically we adjusted about half of our positions. All right, but we still have, well, no, this doesn't count this doesn't count today's adjustment, but we still had $1.4 million of cash in the portfolio, which is the entire value of the portfolio. I mean, the positions aren't worth net anything. So we're putting some of that money to work, but not a lot. We're keeping a huge amount of our money in cash because we don't know what the market's actually going to do. And until we know what it's going to do, we're better off staying in mostly cash. Not that the positions don't have work to do. And as I pointed out when we were going over them, some of these positions are massive. So let's look at the ones that we actually adjusted. Oh, unless I think I'm moving. Oh, all right, like CLF, it's net zero on a $35,000 spread. Cake is a $7,000 credit on a $150,000 spread that's $25,000 in the money. So in other words, this will make $157,125 as cake play. Well, let's take a look at that. Because it's 50, so in other words, 50 $30 spreads, right? 25.55 is $150,000. We have 25 short 45 calls, and it's at 30. So maybe it's in trouble, but we like cake for the long term. So we're going to roll to the 2025 $40 puts, and to the 2026 $35 puts, and to the 2027 $40 puts or whatever the hell I was up to, or $30 puts. We're going to just keep rolling it, and eventually maybe we'll own it, or maybe eventually the Cheesecake Factory will come back into fashion and we'll blow past these numbers. But our worst case is we'll eventually own it at a pretty low price. So what's our target here? Our target is cake. Our target is $45 for the short puts. And if we're at 45, we're still up 100. We have $100,000 net on this spread. This would be zero, and this will be $100,000. So we'd end up with $107,000 profit at 45. And if you look at cake, you think we can get back to 45? You know, it's not about what the chart is, obviously. Let's just take a look at it. But if you want to say, can we get back to 45? You look at cake. And we say, okay, so they're at $1.5 billion. They make 150 million, so they're trading at 10 times earnings right now. Their growth has been spectacular after coming out of this. They've been spectacular because why? They opened restaurants. While all this was going on, Cheesecake Factory opened up a bunch of new restaurants. So while everybody else was crying in 20, because they had plenty of cash. So while everybody else was crying during the pandemic, Cheesecake Factory went to a bunch of malls where people, you know, they like to be in malls. They went to a lot of malls and they said, hey, did that guy go bankrupt? We'll buy that. Did that big restaurant over there go bankrupt? Is that big space available? We'll take that. And they've been building and expanding. So they're now leaping ahead, and they did it, see, from 2020, they went from 1.9 to 2.9, which is more than they ever had before. And now they're at 3.3, 3.5. So now it's normalizing a bit, but they had a huge growth spurt taking over restaurants. And also, they bought a whole other franchising operation out. So now they're going to be back to the slow profit build that they usually do. They're going to be back to like, okay, so in a good year, you know, we're dropping here, you're dropping 5% to the bottom line. Here you're dropping way less than 5%. You know, so they want to get back to 5% to the bottom line, which is what 175 is on 350. And if they get that, they're happy. So then it's all about the growth. So the question is, what's going to happen if I can get to 200 million, which is obviously going to happen with normal growth. So if I get to 200 million here and I get 15x, right? That's $3 billion. They're at $1.5 billion. If I get to 200 million at 15 times earnings, which is perfectly normal for an operation like this, they'll be at $3 billion. That's 100% higher than they are now. And I'm looking for 45, which is 50% higher than they are now. That's pretty freaking reasonable. All right, does Cheesecake Factory have a lot of debt? No, $283 million in debt. So I'm not worried about the debt. I'm not worried about their growth. I see the revenues coming in. This is a nice company that is extremely undervalued. That's why we have such a big play on it. You know, these aren't random decisions that we make, and we don't. I might look at a chart and say, "Oh, that looks good," but it's based on the fact that we have a sound floor. There's a reason we think $45 is a good put price. Just because it's under it now doesn't mean it's not the right price. Oh shit! The Dow went red. The S&P went red. The Nasdaq dropped in half. Wow, that was a late reaction. Good thing we did that. Those cues. Holy shit! All of a sudden, isn't that funny? But that's why. Oh, and the dollar's popping back up. All right, that's why you can't take a chance. Okay, my premise was wrong. My premise was the Fed was only going to hike a half and everybody would rally back. That premise was shot. Therefore, I have to rebalance. And you don't rebalance after you see what happens. You rebalance before to make sure that you can that you don't get burned. You know, we had left ourselves vulnerable And now we covered it up. Oh, is Powell talking? He's talking. Hang on.
Categories. Core prices rose to 4.9%.
Labor demand is strong. Supply remains subdued.
Aggregate demand is strong. Supply constraints have been larger than the one anticipated, and price pressures have spread to a broad range of goods and services.
He says that the supply demand will become balanced. Blaming Russia. Well, it's true, actually. He's very upset about the COVID lockdowns in China. Wow, the S&P is green again. The Dow came back 100 points like instantly. So funny. I feel a lot better with the hedges. All right, now he's doing the boilerplate crap. All right, whatever. Then it goes to Q&A. Where was I? So Kate, fantastic investment. $7,000 credit, $150,000 spread. I don't see any reason you can't get to 45, which is $100,000. It's at 30. It's 25,000 in the money. But it's an aggressive short put. But like I said, realistically, you're going to be able to roll that to lower strikes in 2025, lower strikes in 2026. As long as you got the margin to say, I'm willing to buy 2,500 shares of Cheesecake Factory, that I stand behind that and I've got the money to do it, then why not? Where's that thing? Talked about that. All right, so Disney, we roll down because it's so low. And again, it goes back to, it's like, I don't want to go to value of every single one, but the point is, it's the same thing. It's crazy how cheap this is. You're getting to the point where it doesn't make any sense. Here we are here, right? Back where we were when the parks were shut down, sports were shut down. Disney does ESPN, and they didn't have Disney Plus at the time. So now they've got this whole Disney Plus thing that's going like gangbusters. The parks are open except for Shanghai, and sports are going on again. So everybody's got, so ESPN isn't sitting around with a play. ESPN for a while was playing old games. They were just showing old classic games. They had nothing to show. I mean, it's crazy, and yet you're pricing Disney as if we're still in the middle of the pandemic at the early stages. So I don't know. It's so crazy what's going on here. GLW is a new trade that we took. I like them down here. Hanes, this is crazy also. Hanes sells underwear. It's Hanes and Legs and Maidenform and things like that. I mean, they're a basic underwear company with steady as a rock sales. And I said here, they made it through World War I. They made it through World War II. There's companies from like 1901. They made it through the Depression. They can handle this. They can handle this little recession. They're not going to go bankrupt, but they're being priced like they are. This is the PE is below 6 at this price. It's 10.27 is $3.5 billion for the company that makes 600. It's not a typo. They make $600 million a year, yet you can buy the whole company for $3.5 billion. I should be able to draw up a business plan on a napkin and get a loan for that to buy these guys out. This is insane. I wouldn't want it. They're too boring to run. I mean, who wants to run an underwear company? But still, I mean, this is crazy that it's at this price. It's just ridiculous. And again, what's HBI? HBI is, oh, in this case, we only have the longs because I just was like, I'm not didn't we decide to double up on this? I think I decided to double down. Oh yeah. So we have 80 of the we start out with 40, I think. Where are we? So we started out with 40 of the calls. And I said, let's double down on that. I think it was 40-20, and we doubled down to 80-40. But now we're just doubling down the calls because they're only 210 to double down. So we're doubling up on the. Let me make this quieter. Sorry. So we're doubling up on the calls because it's only 210, and I think that's a reasonable target. I think that $12 plus in 2024 is a very reasonable target. And if it's not, we're going to roll it because it's freaking underwear. We're still going to wear underwear in 2025. So I'm going to stick with the stock for the long term. And maybe one day someone will say, you know what? I'll pay 10 times value. I'll pay 10 times earnings for Hanes. That would be $6 billion, and that would double where it is now. And if we have 160 of these and it goes to $20, we're going to make $1.6 million. Is that right? Nope, make $160,000. Make $160,000. So, meanwhile, off we're paying 34. We paid 34, and we're paying 16 more to double down. So that's going to be 50. So we're going to pay 50, and we'll get 160,000 back if it gets to 20. So if somebody decides to pay 10 times earnings for Hanes, that's what's going to happen to us. I remember how we used to play Victoria's Secret, and then they split up, and we didn't play them anymore. But they've gone gangbusters also. So Hewlett Packard's on track for us. Our IBMs are both performing great, which is why it's the stock of the year for us. Intel, I said let's buy back those short 60 calls because this is also idiotic. Below 40 for Intel? Are they on drugs? Leibu's a disaster. It's just down and down and down and down. There's a lot of activity too. People are just dumping out of that thing. And that's a biotech ETF. I don't get that. Logitech is another boring. These guys are as boring as Hanes. Also way too cheap. Meta, it's now officially Meta. It used to be Facebook, or it's still Facebook. I don't know what they call themselves. No, they called Meta. So Meta used to be FB. First it was Facebook and FB. Then it became Meta, but the stock symbol was still FB, and now they've changed the symbol to Meta. But nothing else changed, no split or anything else. These guys are crazy low also. But we already have a position. We're not that interested. Again, I don't want to spend too much money, and we're not too worried about it, so we're not worried about that position. Philip Morris, we're just buying back the short calls to get them out of the way because they're only $1, so we get them out of the way so we can sell something else later. Pfizer, come on, seriously, this is a money machine. It just does nothing but make money all day and all night. And why would anybody be getting out of this company? This is just craziness. So we're happy for that. So we're rolling down to a deeper position on that one. QSR is another restaurant stock. Rio Tinto is materials mining, and again, it's like the world's not shutting down. They're just throwing out these stocks for no reason. SunPower is our stock of the decade, and you can easily expect to see this again. Target, ridiculous sell-off. There's nothing in their report, and they warned that they're taking inventory adjustments and so on and so forth, but this is what retailers do when the market changes. Oh my God. Whatever Powell just said, the Dow's now up 450 points. Holy shit, the Nasdaq's up 3%, the S&P is up 2%. Wow. He said a 50 or 75 point hike is most likely at the next meeting. I guess the fact that he said 50 and 75 and not 75 to $1, I mean 75 to 1%. I don't know. These people are being batshit crazy. Holy cow. Okay, so Tupperware now. Yeah, thank God we took the spread because the spread's not going to be that affected. It's still the short calls that we have left are going to get killed. So Tupperware also, again, we buy them back because they're just so cheap. It's not worth leaving them on there. They're not going to make much more money at this point. And then Yeti, I can't believe how low these guys are also. It's another big growth company that's priced as if they're going bankrupt. I just don't get the way people buy things. Wow, look at this. This is so cool. Holy crap. Oh, you can't even see. This is what happened all of a sudden when he said something. These spikes are not reversed. This is where we are now. Holy shit. I think these are too laggy. They're not going to reflect it. Let's see. What do we got here? We got 1.47, and let's refresh that. Could go either way. No, 1.498. So you're not seeing the changes that are going to come, but these changes are going to come hot and heavy soon because this is just craziness. But again, that's why the reaction, I didn't want to, we of course improved these positions already this morning, but the reaction is to balance, and that's why it's important to have like a paired portfolio, because it makes it so much easier, because we didn't have to do anything to this portfolio to make us more bearish for Powell based on what happened. We only had to make that one little adjustment in SQQ to balance ourselves out in the short-term portfolio. All right, so we're going to get the same benefit on the short ones, and now we're going to have these Qs. But you know what that means is it means that we could actually sell more long calls if we want to, because now we have 300 more of these. All right, I'm not that confident yet though, because when you see something flip like that, you can't assume it's not going to flip the other way tomorrow. I mean, it's just based on like some offhand comment Powell makes. How front loading? This is what it is. Front loading gives optionality on speed to move forward. In other words, what he's saying is we're front loading our rate raise. That's a good thing to say, because by saying he's front loading it, he means we're adding more right now to get a quicker effect, and then we have the flexibility to cut back later based on the data. That's what the market wants to hear. That we're not blindly going to keep tightening. We're just going to look and see what happens and then make adjustments accordingly. But holy crap, what a spike he just caused. So funny. Wow. Let me tell you something though, as a overall market sentiment thing, raising rates 0.75% and getting a positive market reaction like this psychologically is huge. The Fed is fighting inflation, and the trading public is behind them and believes in what they're doing, blah, blah, blah. That's going to be the narrative you're going to hear. It's going to be great. And it's probably going to scare the crap out of some of the bears now. We will see, unless he says something dumb and we go the other way. But that's incredible. I got to tell you, this is a crazy day on the markets, guys. So let me see if we have any questions. I'm going to wrap this up, and we will see how the rest of the day plays out. So let's see. SK says, yesterday you wrote, just make sure your longs make it worthwhile if the market doesn't go lower or stays flat. What do you mean by this? Sorry to make you expand on that. Oh, I'm sorry. I know you asked me that yesterday. I forgot to get back to you. I mean that like your long-term portfolio. In other words, we know, you know how I write down like if this position goes here, we have an upside potential of this much money, right? So I know, and in the long-term portfolio, there's too many of them to do it on every one, but I know in the long-term portfolio that if the market goes higher, we're going to make like over $1 million, like easily over $1 million if the market bounces back and goes up 10%. All right. So therefore, my short-term portfolio is $1 million. So the entire short-term portfolio can be wiped out, and the long-term portfolio will make up for it. Okay, that's not going to happen, and we're going to adjust and do something in the short-term portfolio not to lose a whole $1 million. But the point is, the balance is there. If you just have hedges and you don't have the other one, then you're making a very dangerous bet that the market will go down. But because we have these longs, because we're going to make $1 million+ if the market goes higher, that's why we have these hedges. You can't have one without the other. You know, you can't have, you should not have, otherwise you're just gambling. Otherwise you're making a bet. And I'm very much not in favor of that. So that's what I meant by that. It said you have to have the balance, and you have to have an idea of what you're going to make if it goes one way and what you're going to lose if it goes the other way. And that's why we're always fiddling with our portfolios, but we've been fiddling for 2 years now. And at this point, it's like we really know the feel of it. You know how like you get used to driving a car, or you get used to riding a surfboard or whatever. You know how it feels, you know where the balance points are, and you can easily make an adjustment. And that's where we are. So in other words, what we did yesterday or 2 days ago is we cashed in 2 of our long old, the lowest SQQ and the lowest TZA calls that we had. We cashed them in because both of them were higher than the spread that they were representing. In other words, they were, you know, one we cashed the TZAs in for 25, and the most they could make is 20 on the spread. We cashed the SQQs in for 35, and the most they could make was 30, I think, on the spread. So we got a bonus $5. But that's also based on the belief, though, that the market had bottomed. And if we're right, we're going to get rewarded because we took very successful short positions off the table. If we're wrong, we have to scramble and recover, like I just recovered the Qs. But our recover wasn't naked. Our recover was a spread that only cost us $4 or total of $120,000 after we took $500,000 cash off the table. So I replaced $500,000 that were at risk with $120,000 that is the absolute max I can lose on that spread. So what we've done now is taken $380,000 of cash out of those 2 positions and protected them. And we've recovered with $120,000 that has a $480,000 upside potential to take care of the exposed short calls. So it's check, balance, check, balance, check, balance all the way across. And you've got to know what you expect to make. You have to know what you expect to lose. You have to know the point at which you're going to get into trouble. And I generally will work with 10 and 20% increments. I want to know what's going to happen if the market goes up 10%. What if it goes down 10%? What if it goes up 20%? What if it goes down 20%? Between here and there, it's almost certain, other than having a 9/11 kind of event, or like if they nuke New York and the market's closed for a month and then we open down 25% or something, you can't protect against that. There's really no realistic way to protect against that. So other than something horrific happening, it's most likely that you know the market's supposed to halt when it moves 10%. So in the very least, I don't think I'm going to get caught with my pants down on a 10% move. And as long as we're well protected for a 20% move, it is very reasonable to assume that we will be able to make adjustments and add more hedges if we see that happening. So you don't want to overhedge. You don't want to be crazy. You want to just be in a reasonable position with a reasonable amount of safety. And look, that's true for everything, okay? It's like life insurance, health insurance. You can't get infinity insurance to cover every possible thing because it's too expensive. You spend more on the insurance than you're going to make. So that's what I'm saying also. It's very key that if you know, life insurance, right? It's good to have life insurance, and I can pay $1,000 a month for life insurance. If I have a $500,000 policy or $1 million policy, it's $1,000 a month. But if I'm not going to make $1,000 a month when I'm living, I got to question the validity of the life insurance. Now I'm just digging a hole. All I'm doing is making myself poorer as I live. I mean, if I'm spending $12,000 on life insurance and I live for 20 more years, that's $240,000. Is that really the best use of $240,000? The policy is only $500,000. If I put $240,000 in the bank today, or into one of these trades, I mean, what did we just say? Frick, Cheesecake Factory. If I put $240,000 into Cheesecake Factory and it goes well, I'm going to have $1 million on that, and I can leave that to my kids. What do I need the life insurance policy for? What am I doing? What is the life insurance policy going to do? It's going to throw some money at my kids when I die. So why not just buy them the Cheesecake Factory shares, put that in their 401ks and IRAs, and let that appreciate over the long term. And when I die, they've got that. Because that's probably going to be worth double what the life insurance is going to pay them. You know, the only way it's better is if I die. Well, actually, it wouldn't be. I take that back. It wouldn't be. Well, it's better if I needed if I didn't have $240,000. That's different. But if I'm looking to cover my kids, I'm better off taking $240,000 of money, putting it into a stock, leaving the stock to my children that I think is going to appreciate, rather than dripping money out of my account that I'm now working for these insurance guys. Now, then you got to factor in, is it an annuity contract and so on and so forth, and how do you set it up? But realistically, I feel much more comfortable investing that money myself than letting the insurance company invest it on my behalf. So the only real benefit to that policy, though, is if I die tomorrow, I get that my kids get $1 million, and the Cheesecake Factory stock will only be worth the $250,000 we started with. So short term, it's better for them. And then you have to weigh out, well, how much am I leaving them in total? How much are they going to be covered? Where are we going to be? And how are they going to be set up for themselves? And what's their earning potential? And how worried am I about them needing the money? You got to factor everything in, but that's true of everything you do in life, right? You've got to factor in. Same thing in your portfolio. You've got to know what you're going to make in good times, what you're going to make in bad times. And that's why I'm very big on having the two separate portfolios, because I need to concentrate. For me, it's been super helpful in my life to have the short-term portfolio and the long-term portfolio. Because when you mix them all together, it's very hard to think about what happens in a good market, what happens in a bad market with the money. When they're separated, I can easily say, hey, if this happens, I'm going to be up 400,000 here, and I'll be down 400,000 there, and that's going to balance out. Just makes life much simpler. But like everything else, though, you have to practice and you have to keep working that system. Not, don't let it take you for granted. And please don't feel bad about asking questions. Okay, it's like this is the most important thing we teach. So yeah, if you have questions, ask them. And the S&P just went flying up and down. So crazy. Wow. Is this updating? Holy shit! Look at that. That is nuts. Is it the 5-minute chart, or is it the yeah, it's a 5-minute chart. And what are we at now? 3780, yeah. Wowie. So now pull back already. And look at these guys are closed and they're following us. So Powell's just driving things all over the place now. So now the S&P is only up 1.2%. Oh my God, it's like a soap opera. Like I said though, balance makes you happy. Byrne says the market's moving up. Why do you think that is after 7.5? It's the whole thing. It's what Powell's saying now that's driving the market. He's saying, okay, if we do 75 now and 75 later, we're ready to pause if we see inflation pulling back. So he's saying we're just front loading it a bit, but that gives us incentive to stop sooner. That's very different than saying, well, we're doing 0.75 because we think we need to do 0.75 4 times this year and have 3% by the end of the year. That scares the shit out of people. So it's really about their longer term policy and what they're really saying. But all this is crazy. Oh, damn, it's 3 o'clock already. All right, guys, I gotta go. Back in the chat room, we're gonna keep an eye on this thing and see what the hell Powell is saying. But this is just crazy. It's really just gonna be about what happens over the weekend now. But yeah, I'm surprised. I'm really surprised, and I was wrong. I did not think they would do this. And I really didn't think that we'd go 0.75 and the markets be up. That's even crazier. So very interesting day, and we will check in again. Yeah, we will check in again next week. Monday's a holiday. It's happy Juneteenth, everybody. I like this, but I wish I had realized. I mean, between Memorial Day and the 4th of July now, we have 3 weekends, extended weekends. So from now on, I'm going to be like looking to take month-long vacations in June. Right, 3 different weekends where the market is closed. That for me is, I mean, that's you know me, I'm here almost all the time. So it's like if I get a chance to have 3 different Mondays off, I want to be somewhere worthwhile when I do that. So I'm gonna have to look and figure out how to do that better next year. I mean, this year I went to Orlando with the kids, and we went to Miami, but jamming it in a single month like this is back to like I can actually go to Europe or something and enjoy it. Because I don't care where I am, I can get up and I can do my work and I can get everything done on my laptops and so on and so forth. But when I'm done and I'm somewhere, that's fun. You know, when I if I'm done with my work, even if I'm in Europe, and in Europe I have to get up at no, I'm sorry, I don't get up. I start working at lunch and I finish late at night in Europe, and that's just my schedule during the week. So what? So during the week for my with my family, I'm not available during the week at the day. I get up at lunch, I go to bed late, but that's just my day. I don't mind that schedule though, or if I go out west, then I just get up super early during the week. And again, it's just an inconvenience. But once it's the weekend, I can go have 3 nice days and go do something fun. Or 4, I take a half day on Friday or something like that. But that's great. That's exciting for me to actually be able to like relocate somewhere for a while and enjoy it. So we'll see. But this is a new world, getting more time off. And people are actually starting to listen to me about, I like this too. England's doing a huge experiment with a 4-day work week right now. Huge national experiment on 4-day work weeks. And I've been, obviously advocating that for many years and saying that this is, the way we do it is stupid. I was an early advocate of remote work. I'm an early advocate of the 4-day work week. It's like, why don't you just work 4 days, 10 hours a day? Everybody would be happier. Makes a lot of sense. Cut commuting times, cut commuting costs also. Why do we do these things? We do things that we did in the 1930s. That there's no reason to do them today. That goes for like having meetings constantly and not doing remote meetings, making everybody come to the office for something, things like that. There's crazy stuff we do in work environments. And I used to do consulting for efficiency and stuff like that. And I've always felt that one of the stupidest things we do is have people work 5 days a week. It'd be so much better if everybody worked 4 days. Anyway, on that note, It's only Wednesday, so let's not worry about it, but enjoy your long weekend, which, has no brand new holiday. So take care, everybody. Have a great day.